Appreciate this opportunity. GuidedChoice is one of the leading investment advisory firms, providing services to over 42,000 defined contribution plans with more than 3.5 million participants and approximately $156 billion in assets. The plans we service range in size from 1 participant to 300,000 participants. With our clients, we set up over 1,000 plans per month on our system, and we offer services through such plan providers as Merrill Lynch, Hewitt, Charles Schwab, ADP, as well as directly to plans such as Atmos Energy and McDonald's. GuidedChoice actually began as a division, part of Trust Company of the West in 1997. As you may be aware, TCW was issued a prohibited transaction exemption, which later served as the model for the SunAmerica advisory opinion. While there, we were conducting market research, and what we discerned from TCW's client base of over 200, typically the Fortune 200, we found employers wanted to provide advisory services to their employees, but were extremely concerned with an asset manager being the one to provide the advice, in spite of the relief provided by the exemption. Given that information, along with the high cost of developing a robust system to meet the market's needs, we made the decision in June of 1999 to spin off the division. That's when I joined with Dr. Markowitz, the Nobel laureate for modern portfolio theory, to start GuidedChoice. There are a variety of delivery models in the marketplace already. At the core of our services are complex software tools that do enable participants to receive investment advice via the internet, but also via phone, paper, or through face-to-face consultation that complies with both the regulatory as well as the plan rules. The plan administrator, plan sponsor, participant, or any combination thereof can pay for the services. Most commonly, I would say the plan administrator or the plan sponsor pays for advice services. Most commonly, if a plan administrator is an affiliate or interested party of an asset manager, we're going to comply with the SunAmerica advisory opinion. All appear to agree that advice is a good thing for participants, and our data also supports that. In our recent survey, over 92% of those surveyed, the participants that had used advice had indicated that they found it extremely valuable for retirement planning purposes. In addition, our data shows it's the savings rate that has the biggest implication on your retirement plan, and on average, savings rates increase 112% for participants using advice. So obviously, getting advice to the majority of participants is a key factor. But in addition, you also have an impact on investment performance that we need to be aware of. When we analyzed our database of expense ratios and quarterly returns of over 30,000 plans, we found that performance can be degraded in plans with constraints. And what we mean by constraints is that a certain number of the investment options in the plan must be from a specified asset manager. So for example, it's a bundled type of arrangement. These arrangements are typically found in the small plan market, but they're creeping into the larger plan market through target date funds created by an asset manager, whereby the underlying investments are a single fund family. In recent years, plans with constraints have tended to underperform plans without any constraints between 0.25% and 2% annually. You can see the data listed below. In addition, the lack of knowledge regarding the risk of investment options and the associated participant behavior of investing has been the subject of numerous studies. One key finding was people's tendencies to be more sensitive to decreases in wealth than to increases in wealth. Empirical estimates found that losses were weighted approximately twice as much as gains. So, in other words, the pain a participant experiences losing $50,000 on their $100,000 account balance is twice as painful as the pleasure they get when they gain $50,000, as we've all experienced recently. Our experience reveals the same, which is why conventional wisdom with regard to the allocation of fund of funds, target date funds, and the like may understate risk aversion for most participants. 98% of advice users are invested in allocations of between 30% equity to 80% equity. Fewer than 0.5% of advice users elect an all-equity portfolio after viewing the effects of risk on return volatility. Of those over age 50, 46% hold approximately 30% in equity, and 53% have 25% or less in equity holdings. So though the allocations may be deemed conservative by industry standards, our experience with participants receiving advice is consistent with the academic studies. The obvious impact of taking less risk to obtain the same income replacement at a chosen retirement age is increasing savings rate. But as we see with the data cited above, most participants elect not to save the recommended amount to reach their goals. So we can extrapolate that they prefer to retire later or live off less income.